Global leaders in crisis. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today is a global currency crisis is imminent, and I want you to understand how the Middle East crisis could be the catalyst that could tip off a full-blown global currency crisis that would then quickly spin into an all-out global financial crisis, which is why global leaders are meeting right now to try to figure out how to put a stop to this, knowing that we're right on the edge of the tipping point. And it's not just global leaders that are panicking, investors are starting to panic too, as I'm going to show you how this could lead to a massive unwind in the US and global equity markets. Now with that, let's head over to Bloomberg, where he picked today's story up with a headline, is Biden's hot economy stokes currency fears for the rest of the world. Now, one of the big problems global leaders are facing right now is their currencies are already weakening against the dollar, and if we see any form of conflict, the risk here is money pours into the US dollar, further driving down all of these foreign currencies, causing central bankers, global leaders all around the world to stop and try to put an end to the free fall, because as money pours out of these countries and into the US financial system, it actually suggests that the global economy then is going to end in an all-out financial crisis as currencies around the world collapse. The pushback from central bank governors and finance ministers gathering for the International Monetary Fund World Bank spring meetings highlight how the sting from a surging U.S. economy, manifested through high interest rates and a strong dollar, is ricocheting around the world by forcing other currencies lower and complicating plans to bring down borrowing costs. And this is again that difference between monetary policy between the Fed and other central bankers. They want to cut, the Fed doesn't, and this is causing a huge problem, because if they start to cut, well, the market perceives that as a weaker currency and looks to short and sell more of that to buy more dollars. But the secondary challenge is, if there's an escalating global conflict, well, people look to safety, and one of those places they look is to the dollar, and right now that's not what global leaders want to see happen at all. And just as officials begin arriving in the U.S. Capitol, Chair Jerome Powell on Tuesday issued a warning that the long-anticipated Federal Reserve interest rate cuts will be delayed yet further due to disappointingly high U.S. inflation readings. And this couldn't be the worst news that these other global leaders and political elites are hearing, because they need the Fed to cut. Because if the Fed can cut rates, then that means all of them can cut as well. But if the Fed doesn't, and they need to, and we know that the global economy outside the U.S. is rapidly slowing, they need to ease rates. But if they do, it puts more upward pressure on the dollar, downward pressure on their currencies, and causes what could be an all-out global currency crisis. Of course, we know how that usually ends, and that ends with, of course, the Fed having to cut rates in a big way. But if we look recently here, when we talk about the Fed's positioning here, the market, when we look at two-year Treasury yields here against the federal funds rate shown in blue, and what we can note is as the Fed was raising rates, the market was saying, hey, you know, Fed, you're going a little too far here, too fast. In fact, we think the economy can't handle it. The Fed says, no, we don't care. We're going to keep raising rates. Of course, the market responded. Then they said, you know what, Fed, we think you've still gone too far, way too much. We're going to say we're going to lead rates lower. Why does the two-year matter? Because look, the Fed follows the two-year. You know, we hear all this rhetoric from Jerome Powell about inflation and the labor market. Look, there's only one thing the Fed cares about. That's two-year Treasury yields, and you can see the yields have backed up here a bit, suggesting the market's starting to buy into the fact the Fed just isn't going to cut. But the challenge is, if the Fed doesn't cut rates here, I want you to understand, they're going to destroy the global economy, the rest of it. And if we take down all of these other economies, well, there's no way we can stand alone on an island. We will soon follow, which is why all these global leaders right now are begging Powell, please cut rates, and cut rates soon, because we need to, or our economies are going to be deep in a recession, and yours will soon follow. Of course, it is concerning, this from the IMF Managing Director Kristalina Georgieva, as summed up on Thursday with a reference to the dollar strengthening. All eyes are on the U.S., she said, with many delegations in Washington questioning how long the Fed will be stuck before it lower rates. That's what I hear from countries, she said, and for good reason. Everybody wants to cut, but they don't want their currencies to collapse because they have no way to defend them. They're trying to, but if we see further fallout, what happens is more money pours into the U.S., more money drives into the U.S. bond market. Eventually, it'll force the Fed to cut. The problem is it's going to cause a massive amount of volatility in the equity markets, and as you'll see later in the show, could lead to a massive market crash. Even Treasury Secretary Janet Yellen weighed in on the same day as she said her counterparts from South Korea and Japan are complaining about the weakness of their exchange rates, offering a nod to their concerns in a joint statement with Asia's top two allies, saying, look, you got your currency is too strong. We need to fix this. And sure enough, they are absolutely right. Here, when we look at that same chart now of the federal funds rate and the 2-year treasuries, that's shown in red against the Japanese yen to US dollar spot exchange rate. And we can see, of course, when the Fed is raising rates, has put upward pressure on the dollar. And what do you see tends to happen? Well, you see rates tend to fall after that in a big way. Now, this is something US investors don't really want to believe can happen. But you can see throughout history it does, because there's one really way to get rid of that strong dollar, and that's to create more. Well, how do you create more dollars? Is it through higher interest rates or lower interest rates? Well, it depends. Whichever one gets more borrowing, and right now it's not higher rates that are going to work. Even South African Reserve Bank governor said, we watch the Fed, but we don't follow it, even though he said actions of the Fed have got huge implications for global financial markets. And this, my friends, is the big issue, because as I mentioned, the Fed here actually could send global markets crashing in a huge way. And that is indeed the challenge as we look forward here to what actually could happen as more money flows out of the global economy into the U.S. It means their economies start to contract because they lack enough dollars. And next thing you know, you have an all currency crisis, a global recession, and anyone that thinks the U.S. can stand strong without the rest of the world, well, it can't happen. But if you're worried about how you're trading or your 401k, remember, we give you the tools. We've shown you this was going to happen and how to protect your money. This is from our CTA Timer Pro report that looks at machine positioning. This is from today's report. And I want you to see the fast algorithm that looks at machines that trade the market very quickly. You see it's moving into a short position. This is warning our subscribers. Look, you need to start protecting your money. Start capitalizing on your gains. Raise your stop loss levels, sell off some of your positions, and raise cash for the next move. So it's not just about trading, it's about protecting your money in other ways. But that's not the only way we alerted our subscribers. How about our Momentum Timer Pro report that looks at all those technical signals that tells you, look, if you're used to trading in late and getting out early, but look at all these sell signals. So we validate, we showed you, look, you can trade with the machines, and that's what we want you to do. When they're deep short, we want you to be buying and riding the wave up, and when they're selling, we want you to get out of those positions. And then from a momentum basis, we showed you again, look at all these sell signals from today's report, and you see the cumulative number telling you, look, this market is going down. There's going to be opportunities. There's a way for you to raise cash. And again, you don't have to be a trader. This could be your biggest pot of money, your 401k. We give you the tools to protect it. And here's the best part. We give you 30 days. Why? Because we're so confident in the research you're getting. It's going to make a big difference. Links in the description below, because when we talk about crushing the global economy, why would, of course, Japan be complaining about the currency? It's relatively simple here. If we look at imports of goods and services against the Japanese yen to US dollar spot exchange rate, what we can say is periods of a strong dollar lead to collapsing imports. And you see that happen over and over again. The dollar rallies, boom, there goes imports, and you see that repeat. And this is a problem because we talk about, why are these other currencies weakening? Is it just because the dollar's rallying? Well, that's one reason, but the other reason is this demand for their currencies is falling. So what you're seeing here is this big discrepancy between central bank rates is causing the global economy to contract. Now, Powell doesn't seem to understand this, which he should, because he's just a domestic domestic banking regulator, but is in charge of the global reserve currency. What his actions are doing is affecting everyone, and now you're seeing why they're complaining. Because if we continue to see a contraction of imports, well, that means all those other countries are going to see their manufacturing sectors go down, which we validated through, of course, all of those surveys, which suggest that layoffs are coming. And then as demand goes down, well, it eventually backfeeds into the U.S. economy with the rate cuts and having to force the dollar to weaken. Of course, that also means bad news for the U.S. equity market. Now, why is the conflict of Israel as they hit back at Iran with limited drone strikes on an airbase such an issue right now? It's because not just because gold went up, not just because rates went down, not just because oil went up, but here's the big one. It's the dollar. It's the safety trade. More money went into the dollar, giving these other political elites big issues that they can't deal with. Is they need to see the dollar weaken. They need to see the Fed cut in a huge way. And we can look over to China and see, look, even they're struggling as the PBOC's easier grip on the yuan may stem from trade-weighted strength. And now people are starting to listen to what I've been saying, suggesting that global demand is falling, and that means demand for their currencies as well. As a stronger fixing fueled the trade-weighted appreciation, the authorities' recent moves to weaken the reference rate suggested they're switching tack to allow for more currency flexibility, mainly because they have no choice. A looser hold on the yuan would also be in line with the People's Bank of China's easy policy stance, although such a strategy risks fueling capital outflows and undermining consumer confidence. And again, we come back to this capital outflows. Where's money going to go? Well, if your money's sitting in a currency that's losing value, that's not a good thing. So what are you going to do? Move it to a currency that is appreciating or at least holding its value, which is the dollar. And on top of that, if you're over there holding dollars, well, they don't pay any interest. But guess what does? U.S. Treasury securities. You want to see how the world's going to get the Fed to cut rates? Money's going to flow into the U.S. Treasury market and drive rates down, force the Fed's hands. Again, they don't care about all the things that they say, care about one thing. It's what the market says, and that's 2-year Treasury yields. And we can see this case that, China's worried about consumer confidence in a falling currency. We see that effect here in the U.S. as we look at the Japanese yen to U.S. dollar spot rate still shown in red against the University of Michigan Consumer Sentiment Survey. And what do you see as the dollar weakens? What happens? Well, sentiment either flatlines or tends to often go down because people lose confidence in the economy. Now, we see, of course, the dollar rallying in strength, confidence up. The only question is for how long, because the issue here is the dollar needs to weaken and needs to weaken in a big way. And as I want to come back to, there's one main way to do it. Yes, you can do forced devaluations, you can cut rates. The big thing is you can create more dollars. Keep that in the back of your pocket, as they could let the dollar yuan fixing slowly grind higher to contain the CFETS index strength. The central bank will tolerate higher foreign exchange volatility if the dollar's index strength continues beyond the third quarter. And right now, it appears that it would, because there's a global dollar shortage. There is a potential rising conflict. People are going to look to safety. They're seeing the global economy slow. They're going to look for safety. That is the whole key here. Money flows to safety and yield. And right now, both of those are sitting here in the U.S. And the appreciating yuan is counteracting with the PBOC's easy policy stance. And to end that policy contradiction, the PBOC needs to accommodate U.S. dollar strength. And what that's suggesting is they actually need to tighten and raise rates, but they can't do that because their economy is weakening. And that is the ultimate problem here. They cannot keep control of their currencies. If the currencies continue to get into free fall mode, that means more money leaves the country and it dives them right into an immediate recession, potentially an all-out financial crisis, putting the Fed with only one move to make, and that's going to be to cut rates. And the longer the Fed holds at this level, the worse it gets for the global economy. And as we look to Vietnam for evidence, the central bank's now having to sell dollars in the market as the dong falls, and that makes perfect sense. Everybody's selling dollars, and why? They need the dollar to weaken. They need to keep their currencies up, and guess what? It's not working, because one of the other issues here is we're seeing a contraction in U.S. commercial lending. We talked about this before. What does that lead to? A destruction of money. You've got a double-edged sword here. Money pouring into the dollar. At the same time, dollars are being destroyed. Dangerous situation for the global economy as the escalating conflict in the Middle East and expectations that the Federal Reserve may delay interest rate cuts is supercharging the dollar and pummeling emerging market currencies globally. Vietnam joins peers in Asia, including South Korea and Indonesia, and pushing back against the U.S. currency's strength in a bid to try to keep their economies from completely falling apart. And here we can see why maybe Fed Chair Powell is happy about the rising dollar. Here again, we're going to look at the consumer price index. We've got the same theme here with the Japanese yen to US dollar spot rate in red. And what do you know is periods of rising or strong dollar lead to a collapse in the consumer price index. So it's entirely possible, as we see this relationship happen over and over, that maybe Jerome Powell's plan here with some hope is that perhaps a strong dollar will bring inflation down enough that he can cut rates. Now, if you don't think he realizes what's going on in the global economy, well, he does, my friends. He understands this. But the problem is he's boxed himself in with this inflation rhetoric, and he needs to see it come down. Maybe in the next couple of months, it's enough. We'll find out soon enough, because looking around the world, you see Japan's inflation goals ahead of the BOJ policy board meeting. Now, this doesn't make sense because they're saying, wait a minute, the currency is weakening. That's inflationary. Except when demand falls. And that's the key point here, is just because the currency weakens doesn't mean you get inflation. If currency weakens and you get demand, you get inflation. But in this case, you don't. And consumer prices, excluding fresh food, rose 2.6% in March from a year ago, cooling from February's 2.8% gain. As we think now, looking in the months to come, this will continue to cool off. A deeper measure of inflation that strips out fresh food and energy cooled to 2.9%, slipping below 3% for the first time since November of 2022. Again, suggesting that despite a weaker yen here, demand in China is going down. How about the ECB? Same story, as here we see Kazakhstan says it's too soon to declare inflation victory. Well, my friend, wait a couple months and we'll see what your story is then. As inflation in the euro area recently slowed to 2.4%. Again, despite a weaker euro here, what are we seeing? Demand go down. Though price growth in services sector has been stuck twice at the 2% goal for months. Preliminary data, meanwhile, suggests that increases in worker pay, a key focus from policymakers, are leveling off indeed. And that makes sense because as inflation goes down and demand goes down, companies can't pass on price increases, can't pass on wage increases, and that means, of course, we know that average hourly earnings indeed comes down in a big way. But what does this mean for the U.S. equity market that everyone believes is a safety trade? Well, watch out, volatility could be coming. As U.S. stock volatility resurfaces with tensions here in the Middle East, as a spike in volatility came after reports of escalating tension in the Middle East, combined with diminishing confidence that the Federal Reserve will pivot to interest rate cuts in the coming months, and with stocks set for their third straight weekly loss, the news prompted investors to snap up the broad market hedges they've eschewed for months. Now, again, we give you the edge on this with our reports. That's the key thing. We teach you how to trade with the machines. We teach you how to trade with momentum, because look what's coming. If the dollar here added strength is giving us any indication, it's a huge warning sign for the global economy. Here you can see again the volatility index. This is the VIX shown in blue. When the VIX goes up, well, usually stocks go down in a big way. Here you can see against the Japanese yen to US dollar spot rate, as that rallies, well, volatility comes back to the market. And you can see that pattern kind of repeating over and over again. But look at this. You see a huge disconnect as a strong dollar is not leading to more volatility as everybody races to the U.S. equity market for safety. But hang tight, if history is any gauge here, world leaders have every reason to panic as their currencies are in free fall. But just wait till the U.S. equity market goes. Investors are going to panic too, because this time there's nobody, as everyone's piled in the long side to save them from the next downturn. And if that's true, then that means the strong dollar is about to unwind the entire global economy. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.